Hello, and welcome to the channel. If you're new here, thanks for joining us, and if you've been here before, thanks for coming back. In this video, we cover a realistic system development process and provide tips for ongoing improvement.
We have our foundation pulled up, our moving average cross to foundation, which is located in our premium strategy lab subscription. So the first thing that we're going to do, we're going to update the values for our moving average. So to do that, we're going to right click, go to studies, and let's update our slow period moving average first. So we see right now we're at a 30 period slow period moving average. Let's change this to maybe 60 and click OK. And then now we can do the same for our fast. Our fast is at a 10. Let's drop this down to maybe 5. And then now we can update our foundation. So in the side of our foundation, we have a lot of different values, different things that you can tweak to really create your own distinct automated trading system. And if at any point in time you want more information about what any of this means, you can always click description right here, and it will open up your browser and display a window giving you information about all of these different parameters here. So we're going to enter on the close. That looks good. This just simply means that we're going to wait for the bar to actually close to confirm our signal. So that's fine. We're also going to continue to use our dynamic risk management system. So our dynamic risk management system is a machine learning system that we've developed in-house that, based upon our exposure, based upon the volatility in the market, using our machine learning models, is going to dynamically select the most appropriate position size for us. So we're going to leave this on, and then we're going to turn on our institutional flow. So our institutional flow is our machine learning system that leverages our liquidity models, which forecast future liquidity. It allows us to detect the presence of institutions. So we can set this institutional flow to different sensitivities. Let's set it to low, so which should filter out fewer trades. And then we won't use our volatility filtering for this particular example, but our volatility filtering system is another machine learning system that we've developed in-house that allows us to filter out our trades based on volatility. So we could say, for example, that we only want to trade when we have increases in volatility if we find that our system performs better during high volatility periods, or we can switch this to decreases in volatility if we were to find that our system performs better during lower volatility environments. And then we could just change that sensitivity as well. But we're not going to use the volatility filtering. We'll just use our institutional flow and our dynamic risk management. So for our exposure, we're going to leave it at 250. Our exposure is the amount that we're willing to risk per trade in USD. And we're going to have a position size range. Let's say from 1 to 10. And we'll rely on our dynamic risk management system to determine the most appropriate position size. We're going to give ourselves a $1,200 daily drawdown. So if we're ever down by $1,200 in a given day, our system will stop trading. And then I think this looks fine. So our max give back and our max give back trigger, these parameters just control once we're up a certain amount in terms of our P&L. If we were to give back, in this example, for example, if we were to give back $500 after being up 1,000, we would just stop trading. And this is a way that we've built in to protect our winning day. So once you make a winning day and you have positive P&L, you want to trade in a structured, conservative way to where you continue to incrementally increase your P&L, but you don't want to give back. You don't want your P&L swinging from positive to negative to positive to negative. So this is a way that we've automatically included to conservatively continue to scale your P&L. And then we're going to move our stop to break even after 20 ticks, which is fine. We'll enter at the close. We're using limit orders here, but there are a few different other options that we could use. And then we're going to, our time in force is going to be good to cancel, but we could use a day day orders, or again other options as well. So for our stop, we do want to use a trail because we're trading a moving average crossover. So what we're attempting to do is capture short or medium term trends, given that we will be applying this to the 1 minute time frame. So we want to use a trailing stop. Our stop loss will be 20 ticks away, but instead of having a 5-point trail, we're going to have a 10-point trail, and that trail is going to begin once we're up by 10 points. So this trigger amount here will determine that once we're up by 10 points, we want to start trailing by the trail amount, which is 10 points in this example. And then we can set our target multiple. Our target multiple is just the multiple of our risk. So if we're risking 250 per trade, then we will place our target 4 times at a profit level that's 4 times our risk. But we're going to change this from 4. How about we place this maybe, we'll say 12 times away, and just to see to give our system a little more room to capture larger term trends, or medium term trends in this case. So this looks good, and we just click OK, and we can apply our settings here. So then we see our moving averages updated. We don't see our slow period moving average because we haven't gotten 60 data points yet. But if we scroll this way, we can see it comes in later. And then we just go back to the beginning of our test period. And we'll be conducting this back test over the last 90 days, just to give us a general feel for how this system could potentially perform. So the next thing that we want to do is pull up our control panel. So we just go to chart, down to replay chart, and over to control panel. That will populate our backtest control panel. We do want to leave it at single chart because we're only replaying this chart, and we want to make sure our replay mode is accurate trading system backtest. We simply click play here, and we do want to clear all trade data for symbol and account. This is simply going to delete prior backtest statistics because we want to look at our trade activity log to see exactly how our backtest performed, and we only want to review this current backtest. So we're going to click OK, and then for our trade activity log, we could just simply click trade, scroll down to trade activity log, and then that's going to bring this over. Okay, so we see our trade activity log has been zeroed out, and we see our query counter, which simply counts the number of background processes happening, is at 0. We always want to wait until this value is at 0 before we begin our back test. So we can simply move this out of the way, and we can click play to start our back test. And we can see immediately that our machine learning models are reading in market generated data, and we're getting some trades as well. So we're going to let this back test run for this 90-day window, and then we're going to come back and see how we did, and we'll review our results. Okay, so our back test just completed. Let's pull over our trade activity log and let's look at the results. Okay, so our system was not profitable over the most recent 90-day period. So we can see a profit factor less than 1, but we have a percent profitable of roughly 27%. Have a significant max drawdown. What else can we see here? Where's looking for our average profit factor. Did I pass it? Okay, here. Our average profit factor is a little over 2 actually. So this is a clear indication that we're taking a lot of trades that we shouldn't be taking. Average profit factor to profit factor less than 1, but we're 27% profitable. So you don't need a strategy that has an extremely high win percentage in order to be consistently profitable. So likely what's happening here is that we're getting into some trades. I'm guessing that we're on side for some time, but we don't trail our stop quick enough, and then the market doesn't move as far as we've allotted for it to move, and then it's coming back and then just hitting our stop. That's my hypothesis. I haven't looked at the data, but that's what I believe is probably happening. So then, as you continue to do more and more back tests and you learn the market microstructure of what it is that you're actually developing systems on, you really understand that the type of system that you're developing, you'll start developing an intuition as to possibly what the problem could be and how you can further improve your system. So just looking at this just briefly, again, we chose some random values, so I had no real expectation for what the potential outcome could be. But just looking at this, a percent profitable of roughly 27%, sub 1 profit factor, average profit factor over 2. We took 216 trades over a 90-day period. My guess is that we're probably getting into some positions. The market is moving marginally, and we're expecting a much more significant move. Market doesn't continue to move, and then remember we set our trail to 10 points. So the market has to be on side 10 points and then begin and continue beyond that for us to begin to lock in profits in this particular scenario. So that probably played a role. So what we can do is look at our trade list. If we look at our trades, we see a lot of information. So we see one thing that's useful to look at is your flat to flat max open profit. So we took a loss here, and you can see how much we were up before the loss. So this losing trade, we were up 100. We scratched on this trade, essentially paying $4 in commission, but we were up 324. Continue, 75 here. Just eyeballing this, we can see this is interesting. Had a really big, winning trade here, string of losses. So just looking at these, these average, these losses and looking at what our max open profit is, it seems potentially to be confirming my hypothesis. Again, just eyeballing this data. So then what we can do, let's test this hypothesis. My hypothesis is that it may not necessarily be that this system isn't tradable. We don't know yet. It could simply be that we need to improve our risk and our trade management. So we're going to make some tweaks, some changes, and then we're going to run this test again, and we're going to see, if my hypothesis, and again, this is all on the fly, if my hypothesis is actually valid or has some validity to it. So I'm going to move our trade activity log, and then we're going to keep this SIM12 data. We're going to change the account in which we're conducting the back test so that we can go back and refer to this SIM12. So we may move to maybe SIM13 or some other account. But before we do that, let's go in and let's update our foundation management. So we still want to enter on the close. We're still taking 250, risking 250 per trade. We're going to drop our daily drawdown from 1,200. Let's move that down to maybe 600. So, our daily stop is half of what we've been risking, because if the market is not conducive to our to the phenomena that we're looking to exploit, we don't want to continue attempting trades when the odds are not in our favor. So we want to give ourselves a few tries to try and capture, to exploit that market phenomena, but we don't want to just continue to trade when the market is moving sideways, in this case, which would be a market state in which is not conducive for our system to be trading. So we're going to take the daily drawdown down. We're going to move our max give back trigger down as well, and we're going to drop the amount that we can give back. So once we're on side 500, if we give back 450 of that, then we stop trading. And then move break even. We're going to tighten. We're going to move to break even sooner. And then we're going to enter at the close. That's fine. Good to cancel is fine. Trail. We're going to have a 10 tick stop, but we're going to have a tighter trail. So we're going to trail by 5 points once we're up by 5 points. And then we're definitely going to significantly reduce our target multiple. We're going to drop that down to a 3. So instead of having a really wide profit target, we're going to constrain our profit target, and this looks better. So those are the changes that we're going to make. And then we need to change our account. So I'm going to trade, attach trade window, and then we can see we have SIM12 currently as the account that we're operating in. Let's change that to a SIM13. So now we're in SIM13, and we can just remove our trade window, and then we can bring back over our control panel, and we can click play here. We do want to clear all trade data for symbol and account. So this time we're trading in SIM13 because we want to see what the impact will be from just making these changes to our risk and trade management system. So we're going to clear out whatever values we have in SIM13, and then I'm going to let this data load. And then once it completes, we'll be ready to restart our back test and test, our hypothesis. Okay, so we have our data loaded, and we have our SIM13 account past values have been cleared out. So we're ready to start our second iteration of this system's back test. So we can just click play, and we can see our models are reading in the market generated data. We see that not a huge spike there. So we're going to just allow our system to trade. And once it completes, we'll look at the updated results. Okay, so our test just finished, and let's bring over our trade activity log and see our updated results. So we can see we still have a profit factor of 0.75, but if we recall, I think we saved maybe $1,000 on this particular run. What else do we want to look at briefly? So our profit factor actually increased to 2.44. So I believe our profit factor from the first run was somewhere around a 2.02. Let's take a look briefly. So in Sim 12, okay, at 2.04. So we took 216 trades originally on 27% profitable, had a 0.75 profit factor, made a loss of 7,100 roughly over a 90-day period. And then when we updated our risk management, our risk and trade management, again, we didn't change any of our key parameters like our moving averages. We didn't change anything with respect to the sensitivity of the machine learning models, the dynamic risk management, or the liquidity or the institutional flow. So we left all of those things intact. We just simply updated our trailing stop, the distance of our stop, our move to break even, somewhat of our central risk management parameters. So ultimately, if we go back, we can see we took fewer trades. So here we had $864 in commission on 216 trades. But then if we go back to our updated run, we paid slightly more in commission on fewer trades. And the reason why we did that is because we actually, by reducing our stop distance and maintaining our exposure or decreasing our exposure, we ended up trading 2 lots on average instead of trading 1 lot. So what's the primary takeaway here? So let's say you get some results like this, you change your risk and your trade management, and then our profit factor pretty much is still the same. It's identical. It's 0.75, even though we paid somewhat, more, I guess you could say significantly more in commission on the update. We still roughly lost 1,000 less than originally. So what this is directly pointing to is that we need to make some changes to our our signals. If we look at our short trades, we're profitable on the short side, but we're really losing money on the long side over this period. Ideally, you want somewhat of a balance in taking your long trades and short trades. So, what's happening evidently is that the system is getting into positions during periods in which the phenomena that we're looking to exploit, which are short-term trends, are not likely to happen. We're taking too many trades. We're over trading. Just given our percent profitable, compare that with our average profit factor, which increased, but we still have the same profit factor here. So what we need to do, which we don't have time in this remaining in this video, but if you're in this position and you're developing your automated trading system and you've updated your trade, your risk management, and you're getting some results similar to this, then you probably want to go back into your foundation, and then maybe you want to tweak some things with the institutional flow, maybe increase the institutional flow, maybe completely remove the institutional flow altogether, and instead of filtering based off of institutional flow, maybe try using the volatility filtering. And then you really need to understand the environment in which your system or the phenomena that you're looking to exploit, the environment that's most conducive to that. And then, so what I recommend is watching your system actually trade, and then that will give you a better idea. Maybe your system is taking some good trades, but given your stop, your risk management, also your entry location, you could be getting stopped out right before the move. These are things that you would have to monitor and actually observe when you're actually developing your system. So, we don't know for certain that this entry at the close, given the parameters that we have set, it may be better that we enter at the prior midpoint. It may be better that we alter our moving averages. Could also be that we shouldn't we should include volatility filtering in addition to institutional flow. There are a number of different combinations that that you would want to try in this position. But the key takeaway is that you want to be aware of what your system is actually looking to exploit. And then you have to do some experimentation and really identify and find ways to identify when the market is really in that state, in that regime upon which the phenomena that you're looking to exploit is more likely to happen. And that's what these machine learning models allow you to do. Liquidity and volatility are two atomic level components of financial markets. So really leverage these liquidity and volatility systems, as well as your dynamic risk management systems, and do some experimentation. So your key takeaway is that try altering and testing your risk and trade management and seeing if that improves your system. Watch your system actually trade. Monitor your system when it's actually trading, so you get a better idea of how it's losing money, when it's making losses, what the environment is. And then if that doesn't improve, you may need to update the settings on your machine learning models within the foundation, and or you may need to change your time frame. It's one thing that you could change, because your time frame, in addition to the combination of these moving averages, how they're set, will directly impact your profit potential, your potential risk or exposure, because you're going to be dealing with different levels of volatility, because you're dealing with different time frames. So you want to keep all those things in mind when you're developing your system.
To access the exact systems and mathematical models shown in this video, be sure to visit our website to learn more. And if you would like to learn more about the professional process we use to design systems, and to do so in a no-code environment, click the link in the description to enroll in our free course, Automated Trading Foundations. Be sure to follow us here and on our other social channels to receive additional insights to fast-track your automated system development.